This week, our Federal Reserve raised interest rates another 25 basis points, despite what many believe is a detrimental move to the U.S. economy, with the recent banks collapsing, waning consumer confidence, and the economic struggles of many Americans as it pertains to high energy costs, unaffordable housing, and transportation costs, despite potential bailouts of defaulting mortgages and bank bailouts, and the out-of-control spending of our federal government. Jerome Powell has shown the FOMC's commitment to using their only blunt force tool to reduce inflation to the 2% target at all costs. All the while, the Fed's balance sheet jumped recently by hundreds of billions of dollars, bailing out banks, injecting an estimated $440 billion into bank reserves. All right, welcome back and thanks for watching. And in this video, we're going to discuss the Fed's March 22nd announcement, listening to the highlights of the press conference to spare you from the entire 44-minute announcement, including the back and forth of the Q&A from the press. But hey guys, if you care to watch the entire press conference, I'll drop the link below in the show notes. After watching this video, I'd like for you to comment to what you believe will happen this year to the housing market, the jobs market, and the overall economy. I believe there's wisdom in crowds and everyone loves reading your comments. If this is your first time watching, I'm Todd Sachs. I'm a real estate broker here in Maryland, and our channel is dedicated to keeping you informed on everything real estate. And if you like it here, please consider subscribing to our channel and hit the alert bell. You'll be notified every time we post content. And as always, don't just keep this information to yourselves. Please share it with your friends. Share buttons below. Now, we all know real estate sales are down as much as a third from last year due to higher mortgage rates and home prices that most people feel are still way overpriced. However, many home sellers did benefit from a slight uptick in home sales in January and February. But let me tell you, with this week's 25 basis point rate hike, that slight uptick in housing sales may reverse as mortgage rates could rise further as credit tightening is expected as a result of the recent bank troubles. In other words, this week's further rate increase happened at a time when many believe with the recent bank failures, the Fed would either pivot, reducing interest rates, or at least stalling them. Obviously, neither of which occurred. With the Fed's rate hikes over the last year, higher mortgage rates have followed suit. And guys, this is what crashed home sales along with their attempt to reduce inflation. Unfortunately, these higher mortgage rates came a little too late, some may say, as the all-time low rates to stimulate the economy during the pandemic allowed home prices to barrel out of control. Many believe rate hikes should have been a slower pace over time and started at least a year earlier. As many also believe the all-time low rates that began in the beginning of the pandemic caused the inflation rate and home prices to skyrocket. All of this out of control inflation, and now with the recent banks collapsing, depositors are said to have transferred billions of dollars from regional banks to the too big to fail banks in fear of more bank troubles. So now with money fleeing to bigger banks over the last 2 weeks, will we see the need for more bank bailouts for smaller regional banks? Let's take a look at this article from Reuters.com published on March 22nd. If this month's U.S. banking stress owes at least something to the Federal Reserve's reduction of its mammoth balance sheet, then the central bank may now find itself digging deeper into a hole of its own making. 2 weeks of turmoil in mid-sized U.S. banks followed just 9 months in which the Fed had been winding down its outsized balance sheet that peaked nearly $9 trillion during the pandemic. This policy reversal, dubbed quantitative tightening, has proceeded alongside the steepest interest rate hikes in decades. So now let's take a look at this chart. It says the need to extend roughly $300 billion in emergency credit for the banking system this week has cut in half the progress the Fed has made in reducing the size of its balance sheet since last June. And JP Morgan estimates that the Fed injected $440 billion in bank reserves. And let's look at this. It won't stop the already tight lending standards across the banking industry from getting even tighter. It also won't prevent the cost of deposits from rising, thereby pressuring net interest margins, according to Morgan Stanley's Mike Wilson. The risk of a credit crunch has increased materially. Now, I'm telling you right now, this may only be the tip of the recession iceberg, as businesses are laying off tens of thousands of employees already this year. And as we listen to some of the highlights of the Fed's economic outlook, you'll hear that inflation has risen from January to February. Wage demand has been reduced, and so far we are nowhere near the 2% inflation target. So should we expect a prolonged period of high interest rates, or at least staying where they are for now? So what should we expect next?
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par.
According to an article on CNBC, institutions borrowed $53.7 billion from the Bank Term Funding Program as of Wednesday, up sharply from the $11.9 billion last week. Another category of loans made mostly to shuttered banks to meet obligations to depositors and other expenses jumped as well. These borrowings surged to $179.8 billion from $142.8 billion last week. The new bank funding program was introduced March 12th to alleviate similar strains on banks and other institutions. It extends one-year loans backed by the Treasury or other assets, paying full price for the assets even if their market value is lowered. So, banks are borrowing more from the Fed.
This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again.
So now I ask you, with the Fed's balance sheet expanding, does this mean the end to quantitative tightening? Now, for what we've all been waiting for.
Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
So inflation is not responding to the rising interest rates. And this is exactly what was asked of the Fed Jay Powell when he addressed Congress a few weeks ago. Some say that by purely raising interest rates and not focusing on corporate greed, it's only further hurting our economy. And now it's hurting the banks. And as I mentioned earlier, these rate hikes have drastically reduced affordability in the housing market.
In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates.
So what's going on with our jobs?
Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year.
So wage growth has shown some signs of easing. Easing upper pressure on wages. So unemployment is predicted to rise and wages will what? Go down? So Powell just said 4.6 unemployment expected by the end of 2024. Now, just so you know, in November, right before the 2008 housing market crash, unemployment had hit 4.7% before skyrocketing to 10% in 2009. This, my friends, is exactly what Senator Kennedy had asked Powell during his meeting with Congress several weeks ago.
Now, if history is right, I'm not asking you to again, blame anybody. But if history is right, unless you get some help in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2% based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in play here.
I know you're reluctant to admit it.
So now what's going on with the inflation?
Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
So let me get this right. Despite raising interest rates, inflation actually went up in February over January, and getting inflation down to the 2% will extend into 2025 and is likely to be bumpy. So exactly what do we do when things haven't worked so far?
At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment.
Maybe something else may be necessary in the future, not necessarily further rate increases. But Powell did mention that with what's recently occurred in the banking industry, further credit tightening and tighter credit conditions for both households and businesses may be necessary. So I guess the possibility exists that due to this tightening, we may expect even higher interest rates on consumer loans and maybe even mortgages. That is, maybe unless the Fed starts to purchase even more mortgage-backed securities. Okay, so I'll leave you on this note. In this recent article on Fortune.com, the upheaval in the financial system that's followed the collapse of the two major U.S. banks is raising the likelihood that lending standards will become sharply more restrictive. Fewer loans would mean less spending by consumers and businesses. That, in turn, would make it harder for companies to raise prices, thereby reducing inflationary pressures. At the same time, some economists worry that the slowdown might prove so severe as to send the economy sliding into a painful recession.
Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really 3 parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February and we still don't have now is a sign of progress in the non-housing services sector. And that is, that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet. And that's of course, 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
All right, so I like how he referenced guesswork. Thanks for watching, guys. I appreciate you all. And as I said earlier, I would love to hear your comments. You can drop them below. If you like this video, guys, you can let me know that you did by smashing that thumbs up. And also, if you haven't already done so, take a minute, please subscribe to our channel, hit the alert bell so that you'll be notified every time we upload content just like this. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.